Michael Burry revealed a startling revelation on one of history's most shocking catastrophes. Nobody knows what Burry sees, just as in 1999 and 2008, but the world is due to awaken shortly. Unsurprisingly, the $5 trillion in money that the Federal Reserve produced caused prices to surge. As a result, the inflation rate is currently 8.6%. Burry disagrees with the mainstream media because he believes short-term inflation will decline. Although the Fed did print at a rate of 1.5 trillion per year during the pandemic, the opposite is presently happening. The Federal Reserve intends to reduce the money supply by $1.1 trillion annually. Prices should fall if the Fed stops printing trillions of dollars, since they did so after prices increased. This takes place when supply networks begin to catch up on demand. Over the past few years, supply chains have been under strain, but this is starting to change. Unfortunately, the world has yet to stand by and watch while the pandemic spreads. We are wired to adjust to a changing environment. There are now supply chains in place. Businesses are becoming more productive, the building of container ships is increasing, the worry over the availability of goods is in full swing. When too many goods are on the market and not enough people want them, prices will fall quickly. As a result of an oversupply, stores will have to start lowering prices by having mass sales. The bullwhip effect occurs when a surge in demand prompts suppliers to place excessive supply orders. This is because companies often order a little more stock than they need as a backup. The issue with this is that the supply can be inflated to unsafe levels when a network of enterprises all place extra orders. Typically, retailers, wholesalers, and manufacturers make up the supply chain. This example shows how putting in too many orders at each step of the supply chain leads to a surplus of orders. The bullwhip effect got its name because of how it is compared to a bullwhip. Because of the severe supply shortfall, retailers have ordered boatloads of stock. One of the largest bullwhips in history resulted from this. Additionally, a supply glut is unavoidable when there is a bullwhip. Burry knows that there will be deflationary forces and a price drop when too many goods are on the market. When the pace of inflation sharply declines, there is a disinflation, as many people think inflation will soon stop going up and start going down. The bullwhip effect could lead to deflation, which could cause the Fed to start making money again. This is called quantitative easing. When consumer demands increase because of quantitative easing, there will be an even bigger supply of goods. Next, the Fed will start quantitative tightening, which is also known as taking money out of the economy. This is done to stop inflation caused by a lack of supplies. The only issue is that shops will order more stock, bringing about the bullwhip effect. If there is too much supply, prices will go down, forcing the Fed to restart quantitative easing. This would make consumers want more, but there would need to be more. This would just set the stage for another bullwhip. Such a cycle is unsettling since it keeps the economy mirrored in a cyclical downturn. We are currently in the bullwhip phase of this cycle, which means that soon we will see the worst crashes in history. No matter how well known it is, the bullwhip effect is simply a result of human nature and cannot be prevented. Burry elaborated on the bullwhip effect by saying, across the economy, different verticals are in different phases simultaneously, but fundamental equity investors rarely look at more than one vertical at a time. Burry is essentially calling for a massive bullwhip across the entire economy. Thus, the bullwhip is wider than big box retailers like Walmart and Target. Other industries from production of planes to cell phones may also be included. Burry's tweet included a link to a website for the beer game was explained. The beer game has nothing to do with drinking beer, despite what you might believe. The beer game aims to replicate the beer supply chain. The game has 4 units: brewer, distributor, wholesaler, and retailer. In the game, students are divided into 4 groups, each of which is a unit. The most significant profit is what each team aims to achieve. It happens that inventories are excessive towards the conclusion of the game. This is because each of the 4 units always orders more beer, which makes the results even bigger. The bullwhip effect is just a function of human nature, as shown in the beer game. The bullwhip effect is currently in effect, as retailers have already seen. Bullwhip effect is evident because store stocks grow 10 times faster than their sales. As was already said, the bullwhip effect doesn't only happen once every 10 years. It's a vicious cycle that only gets worse with time, with prices mainly rising in the long run. From 1966 to 1982, the Dow Jones reached new highs as cyclical inflation reduced dollar spending to just 35 cents. There was never a deflation to reverse that. Prices periodically increased and decreased as a result of the bullwhip cycle. At the end of the cycle, however, there was one last price spike that didn't have a corresponding drop. As a result, prices fluctuated but ultimately rose over time. The bullwhip effect grew even larger as inflation continued to rise over time. Prices substantially increased throughout the 1970s. Because inflation remained noticeably positive, it never decreased again. During the most recent spike, the inflation rate stayed at 2%, the same as it was during the first bullwhip. Burry tweeted an article announcing the inflation relief payments that Californians will receive. This is ridiculous because giving away free money will only worsen the inflation. Even though the current economy is undoubtedly alarming, there must be hope. Burry believes that this hope will only appear for a while. He tweeted a quote from billionaire Tom Siebel saying, "I don't think this is going to be over until everybody swears they will never own crypto, and they will never own a technology stock." Burry commented, "Such a sign in 2002, 1932, and 1974. 09 was a panic bottom. But 07 was not a speculative stock peak. We experienced a speculative peak in 2021, and speculation typically ends with everyone being scared of speculative assets. We're currently not there yet at the moment." Burry hates Bitcoin, yet it's still a fairly common asset today. Burry tweeted a graph of the Nasdaq Bitcoin correlation and asked, "Are we sure Bitcoin isn't just another risk asset on the Nasdaq 100? As evidenced by the significant correlation between it and the Nasdaq, Bitcoin is not an uncorrelated asset. The fact that Bitcoin's price goes up and down like the Nasdaq shows that it is just another tech stock with a new name. Some, like Jim Cramer, may see a brief rally as a sign of recovery. Burry is aware that the market crashes occur when short-term rallies occur more frequently. Having the biggest rallies amid market breakdowns may seem counterintuitive, but history has proven it to be the case. Burry tweeted, "Who knew this year would be so much fun because of all the doomed rallies? Recall 1929 to 1932, top to bottom. 10 rallies above 10%, averaging 23%. From 2000 to 2002, 16 rallies exceeding 10% with an average of 23%. So, several 10 to 25% rallies after each massive crash lasts for years. This happens every year. These rises, meanwhile, shouldn't be interpreted as an indication of a sustained market rebound. In a down market, short-term rallies have no significance. So, given that, how is Burry getting ready for the impending crisis? People can say whatever they want, but they're only pretending and seeking attention if their actions don't match their words. Burry puts his money where his mouth is, unlike other market crash forecasters. Make sure you hit that subscribe button so you don't miss out on helpful financial news, tips, and strategies. Thanks for watching. We'll see you in the next video.